Hello.
Hello.
How are you?
Doing well. Welcome everyone to our third YouTube Live of the year. Today we're going to be talking about tax planning strategies. But before we dive into the topic, uh, quick introductions.
Yeah, I am Danica Waddell. I'm the lead planner, founder, president of Xena Financial Planning, and we are a virtual firm. We work primarily with women in the tech industry. And you are?
Yes, and my name is Mariana Llamas, and I'm an associate financial planner here at Xena. And before we do talk about our topic for the day, we're trying out this new thing where we want to highlight a story or a woman that has inspired us recently. So for today's live, we are going to highlight these two teenage girls from New Orleans who have made it onto the news because they have proven this mathematical, mathematical theory that has not been able to be solved in the last 2,000 years. So it's amazing that these two high schoolers could do it. That has never been done before. So a reminder not to undermine the next generation.
Mm-hmm. Mm-hmm. Yeah, this story, we were chatting about it earlier, is pretty cool. So these two teenagers, it had to do with like the Pythagorean theorem, and there are actually many, many proofs already of this theorem, but they're all circular logic. So they all rely on the theorem itself in order to come to a proof. And so they came up with a way to do it without relying on the Pythagorean theorem itself. So some mathematical journals are sort of looking to publish their results and all of that, but really exciting to see some quite young budding mathematicians doing something pretty innovative.
Yes, yes. So definitely check it out and read about it further, especially if you're a mathematic genius or you like to geek out about all of this.
Yeah, we got a little lost. We were like, let's pull up this theorem. I was like, oh, that's probably over our head, but it's
Yeah,
still cool.
yeah. So for today, we have, since we also work with a lot of individuals in tech, and we are in tax season, the best season of it all. Kidding, but so we wanted to talk about a couple of tax strategies that are very relevant to these two people that work at these tech companies. Because a lot of times, tech companies, you do have a lot of benefits that not if you work at other companies, they don't necessarily have. So, so why don't we start off with, I guess, ways to that one can reduce their tax liability.
Yeah. Yeah, that's a great place to start. So, we do generally work with people who have pretty high incomes. And one of the things that we hear all the time is, what can I do to reduce my tax bill? So the things that are the easiest to consider in terms of how to bring down whatever tax you owe is contributing to any kind of pre-tax account. So what that means is, if you contribute to your 401k, that money that goes into your 401k, you don't have to pay tax on if you're doing a pre-tax or a traditional 401k contribution. So like in 2023, you can contribute up to 22,500 or even more if you're over age 50, and that money is not taxed. So that's a great place to start. I think it's worth mentioning that there are a couple other ways that you can contribute to 401k, just to be clear about those so people understand the differences. Most of the companies that our clients work at have an option to do either a pre-tax 401k contribution or a Roth contribution. And a Roth is just you do the contribution, but it's after tax, so you don't get kind of the tax benefit now. You do get a tax benefit later on when you take the money out, but I think it's important to know that there's a difference. And many people ask us, which of these should I do? Should I contribute on a pre-tax basis or an after-tax or Roth basis? And that's a pretty complex question, to be honest. There's not really a right or wrong necessarily, but it really comes down to kind of what tax bracket are you in today? What tax bracket do you expect to be in when you're retired? And also how high your income is. So if you're in the 37% tax bracket, the highest tax bracket, it might make sense to do your contributions on a pre-tax basis. Whereas if you're in one of the lower tax brackets, it more than likely it makes more sense to do a Roth 401k contribution. So there's a lot of factors that I'm really oversimplifying that right there, but just wanted to sort of point out that there's lots of different types of 401k contributions, or not that many, I guess, but to really understand the difference between pre-tax and Roth and when to think about which of those might make sense for you.
Yeah. I'll add in there too, just really briefly, that I think we do see this a lot with people that work in tech where they do want to retire very early. So if that is something that you want to do, then maybe you don't want to put 100% tie up all of your money in retirement accounts, like pre-tax or after-tax 401ks, regardless, because then you won't be able to take that money out without incurring any penalties very later on.
Yeah, great point. So if your objective is just to pay the least amount of taxes, feel free to load up on the pre-tax 401k and max that out. If you expect to retire early, it might make sense to just contribute enough to get the company match. And then maybe you actually keep extra money outside of your 401k to give you more options in terms of when and how you can take the money out. That's a really good point.
Yeah.
One other thing I'm just going to throw out, we're not going to do a deep dive into this, but just want to mention that there's also something called an after-tax 401k. That's also very popular in tech. Lots of the big companies offer this now. It does not do you any benefit from a tax perspective today. So if you have the option to contribute to an after-tax 401k, they're awesome. I mean, I think they're a really good idea for a lot of people, not for everybody. But it does not actually help you from a tax perspective in terms of today's tax liability. So again, that's an option that makes sense for a lot of people. It's just not in terms of today's conversation and reducing your taxes. It's not going to give you any benefit there. So I would prioritize the pre-tax 401k first. If you have extra money to save, the after-tax 401k might be a great option for you. It's just not going to reduce your tax liability.
Yep. How about anything else other than just like a 401k? What other benefits could reduce your tax liability?
You could also take advantage of a health savings account if that's an offering at your company. So a health savings account is a really cool account. We've talked about that a few times. Lots of benefits, one of which is any money that you put in today will be pre-tax, so you won't pay tax on that. The downside there is just, of course, the money has to be spent on healthcare, but also the limits are pretty low. So you can only put in, about $3,800 a year if you're single, $7,600 or so if you're a family. And if your company puts money in, that goes towards that total. So we've seen people whose companies put in so much, they're only able to contribute, maybe $1,000 a year, and then they've hit the limit. So the limits are relatively low. But if you have the option to contribute to an HSA, they're great accounts. We are big fans. And so that's another way to bring your tax liability down.
Yep. Any other options that are available? I know being a W-2 employee, you are kind of very limited to what you can do. Are there any other benefits that a company could provide that would benefit you?
There are no other pre-tax benefits that I'm aware of. You might, if your income is low enough, you could potentially contribute to a traditional IRA, and those contributions could be deductible. Almost all of our clients make money above the threshold for having those contributions be deductible. So that's not a company sponsored benefit. That would be something you would set up outside of your employer. So a traditional IRA could be an option, but more than likely, if you work in tech, you'll make too much money to be able to take advantage.
Okay. So if you work in tech, you most likely receive equity. Let's talk about, I guess, from a tax perspective, so this is outside of just like reducing your tax liability, or this is aside from that, what are things that one should consider if they are receiving any type of equity?
Yeah. So you're right. There's not a whole lot you can do necessarily to reduce taxes here, but there are some things you might want to keep in mind, things to look out for, and there are ways to, to sort of be tax efficient, I guess, with the different types of equity. So we're not going to go into great detail on all of these, but I think relatively quick summary on what the different types are and how to think about the taxation. So RSUs, or restricted stock units, of course, are the most common type of equity that we see. And that is, you work for Amazon.com, you get some company stock, it vests, over a period of 4 years. When that stock vests, it is 100% taxable the day that it vests. So that will show up in your W-2 income. You probably are familiar with this already. The challenge is most companies will withhold, they'll sell a portion of those shares the day that it vests. So most companies will sell 22%, and they'll pay that to the federal government for your taxes that year, which is really nice. It's nice that they kind of just skim some off the top and then they give you whatever's left. The challenge is most people we work with and people that work in tech are in a higher tax bracket than the 22% tax bracket. So what happens is, for a lot of people, they get to the end of the year, they go to file their taxes. The company's only withheld 22%, say, but they're in the 35 or 37% tax bracket. And they get this sort of unexpected tax bill, like, oh my gosh, I owe $20,000 in taxes because my company didn't withhold enough.
Mm-hmm.
So there's a couple different ways that you can manage that, but I'd say the first thing is to double check with your company and see if they can withhold more. So some companies will allow you to change the percentage that's withheld on your RSUs to 30 or 35%, something like that. If that's an option, that's the easiest thing to do. And then when you do your taxes, you'll kind of true up what you actually owe with what was withheld. The other option is to just set aside taxes, or set aside money for taxes throughout the year. So every time your stock vests, if you know that you're going to be in the 35% tax bracket and your company is only withholding at 22%, you might set that extra 13% aside, and maybe more if there's state taxes. So, you could do that manually. You could come up with that number with either a tax professional or a financial planner could help you calculate that and sort of set that money aside throughout the year. And then when tax time comes around, it's like, okay, well, I have this savings account with $20,000 in it that I've earmarked for taxes, and you've already got that money set aside.
Yep. I think this is like the number one thing that people that are receiving RSUs get surprised by, and especially if they are not selling it. And then come tax time, it's like, wait, I actually owe tax, but I haven't sold anything. And then now the stock is a lot lower than when it was when invested. And it just gets a little bit more complicated. But yes, regardless if you do sell it, you will owe taxes on the RSUs as soon as they vest.
Yeah. Right, exactly. The other things that we see most commonly are employee stock purchase plans are a big one. Mm-hmm. So that is where you're, buying your company stock at a discount, and then at the end of every period, it's usually a 6-month period, but the company actually buys some stock on your behalf, and you get it deposited into an account, but you've paid, usually it's 15%. It's usually a 15% discount on whatever the price is. I'm not going to go into great detail on employee stock purchase plans, but I will say, if you are participating in an ESPP, you should definitely work with a tax professional. They are probably the most complex from a tax perspective of any kind of equity compensation. Mm-hmm. And so there's different taxation situations depending on whether or not you sell it right away or you hold it for a certain period of time. So there's qualifying and disqualifying dispositions of that stock, and they're treated differently. So there's a lot of complexity there. I would primarily say to work with a professional. My other recommendation with ESPP is, again, depending on your situation, but I often recommend that people sell the shares as soon as possible. Mm. So it is not a qualifying disposition. It is not the most tax efficient, but it's the most straightforward. And it also reduces your stock concentration. So if you hold your stock a year or longer before you sell it, you're opening yourself up to the potential for that stock to go down. And then you might sell it and owe tax on a discount, and you might have lost money. So it can get really, it can have some negative long-term effects if you hold on to the stock. So even though it's not the most tax efficient, I usually recommend people sell as soon as those shares are purchased.
And you've written great articles on this. So if you do head over to zenafp.com, Danica has written examples on like basically all of the types of equity comp and how taxes look like for each with examples as well. So definitely recommend checking that out. What about incentive stock options?
Yeah, so the other things we see most often are incentive stock options and non-qualified stock options. Incentive stock options, when you exercise them, you don't owe tax right away, but you might trigger something called alternative minimum tax or AMT, which scares most people. You know, most everybody I know wants to avoid AMT at all costs. It's not necessarily a bad thing, but it's really important to know that you are going to have that potential tax bill next year when you file your taxes. So it depends on how much you exercise and what your income is. So it's not a guarantee that you will trigger AMT, but it is possible. And so it's just something to be very careful of when you are exercising, and almost certainly work with a financial professional or a tax person or both. And one of my caveats with working with a tax professional is a lot of tax people don't understand incentive stock options. And so you really need to find somebody that knows what they're doing, or you will get inaccurate advice. So this one's just something to be really careful about.
Yes. And we have found that even working with CPAs, and they are also prone to make mistakes, especially if they are not comfortable with dealing with stock options, because that is a whole nother realm.
And then non-qualified stock options are the least complex, but they do have a tax implication when you exercise, and it's also subject to FICA taxes. So you're going to pay Social Security and Medicare on the exercise as well. So just being aware of kind of all the moving pieces. But I would say non-qualified options at least are a little bit simpler than incentive stock options. But it gets really complex, especially depending on, do you exercise and hold, exercise and sell? The tax implications are totally different depending on which of those things you're doing.
So from a tax standpoint, like if you are receiving equity comp, which type of equity comp would you recommend that it is absolutely like highly recommend to work with an accountant?
Yeah. My opinion is ESPP and incentive stock options are the most obvious choices. If you have those, almost certainly you want to work with a tax professional who knows what they're doing. If you are just receiving RSUs and or potentially non-qualified options, you might be able to manage that on your own. RSUs, again, are relatively straightforward. But ESPP and incentive stock options, I personally would not recommend anybody do those without tax advice.
Good to know. Anything else that you see with equity comp, like again from a tax perspective, that see a lot of people miss?
Yeah. I would strongly suggest tracking cost basis on your own. So that's one thing that I've seen come up before, where sometimes a custodian doesn't report cost basis correctly and you end up kind of double taxed. So, I don't really trust custodians to report that stuff accurately. I would, to the best of your ability, I would keep track of cost basis on your own so that you can verify, because there can be some pretty significant differences depending on, whether or not that's accurate.
Yep. Okay.
I think there was one other thing I wanted to touch on relatively briefly, but I think in terms of bringing your tax liability down, we didn't talk about things like charitable giving or even something like a donor advised fund. And I mean, that is a way to reduce your taxes. So if you are charitably inclined and you're interested in donating to charity, you know, whether you donate cash or you can also donate highly appreciated stock is another way to do that. You can set up a donor advised fund. There's lots of different possibilities for giving, and they do reduce your tax liability. I would say you probably don't want to do those things just because they bring your tax bill down. So if that's something that appeals to you and you want to be creative about how to do that in the most tax efficient way, by all means. But I don't think anybody should, you know, donate to charity just to reduce their taxes or set up a donor advised fund just to reduce their taxes. You know, that's sort of spending money to save a little bit of money. Doesn't make a whole lot of sense, but those are definitely options. And I think if you're interested in those things, there are definitely ways to do it in the most optimal kind of tax efficient way. And that's something that you'd probably want to work with somebody who understands those different systems a little bit better, but definitely options for reducing your tax liability.
So if someone wants to reach out to us, where can they find us?
I think the easiest place to find us is probably our website. So zenafp.com. You can contact us directly there, schedule an intro appointment. We're on various social media platforms as well. So Instagram, Twitter, YouTube. What else are we on? I think that might be at LinkedIn.
Yeah.
But I do want to just mention, because this was a pretty tax focused and technical conversation, that nothing that we said today is specific tax advice. Almost everything that we mentioned is, you know, very dependent on your situation. So we definitely recommend working with a financial professional or a tax professional to get advice that makes sense for you.
Mm-hmm.
But this, the conversation is hopefully useful from an educational standpoint.
Yes. Yep. And like I mentioned earlier, our blog page does have a lot more educational content on there. If you are interested in that. But anything else that you wanna add to the conversation before we wrap up?
I think that's mostly it. I think there are a lot of pitfalls with equity compensation. So, you know, reducing your tax liability, there's a limited number of options there, like contributing to your 401k, HSA, charitable giving. But I do think there's a lot of pitfalls with equity compensation and the reporting and just really understanding how the different types of equity are taxed, what's being withheld, and planning for that throughout the year so that you're not caught off guard when you go to file your taxes. So that's really the big thing, I think, is just understanding, preparing, and not being surprised by, you know, a 5 or 6 figure tax bill.
Right. Or you find out that you can't file your taxes on your own because you have incentive stock options, for example, and you wait at the last second and now you can't find a CPA to work with you.
Mm-hmm.
So yeah, emphasis on the preparing ahead.
Yep. Like many things that makes sense from our perspective.
Yes.
But yes, please reach out if you have specific questions or would like to chat more. Otherwise, I think it's not 2 weeks till the next one. I think it might be 3 weeks.
Yes.
I'm on vacation.
Spring break.
Yes. Spring break. So we will be back in 3 weeks.
All right. Thank you.
Thanks.